Hello everyone, and welcome to yet another interesting video we have to share with you. So we're still on the matter of fundamentals vis-a-vis investing in the stock market and making money in the stock market. We've done videos on general overview of what fundamentals are. In case you have not seen that video, you can check our page, you'll see the video. And then we've also done a video on the debt to equity ratio, a very important metric that investors use in determining which stocks to buy and which stocks to avoid. Right. So today we're going to go a little deeper in doing all the fundamental analysis that savvy investors engage when they make stock investment decisions. So I'm going to be looking at two of those metrics in this video. The first one we're going to be considering is the one that is called the quick ratio. Okay, the quick ratio. What's the quick ratio? The quick ratio is the ratio of what you call quick assets or current assets over current liabilities. You might be wondering, what is a quick asset or what is a current asset? Current assets are assets that you can easily dispose to make money. Okay. They are assets that you can quickly put on the market and get financial value in exchange for those assets. Okay, so that's what you call quick assets or current assets. And then current liabilities are liabilities. Of course, we have defined what liabilities are. Liabilities involve debt, involve payment commitments and payment obligations. Okay, so when you say current liabilities, you're looking at liabilities that fall due within a 1-year period. Okay, so current or quick assets over current liabilities, the ratio of the two is what you call your quick ratio. Now, why is it important to consider the quick ratio of a stock of a company you want to invest in? Now, the quick ratio gives you an idea of a company's ability to meet its financial obligations as at when due. Okay, so if a company is supposed to pay out, say, 50 million or 100 billion or whatever amount in 2 weeks or in 3 weeks, if you look at the quick ratio of the company from their balance sheets, from their financial books, and you do your numbers, you should be able to tell you that, this company will be able to afford to pay this amount of money at the stipulated time. It's important. So it's a measure of the company's liquidity, all right? Company's ability to meet up with its financial obligations. That's very important because cash is important for every business. Liquidity is important for every business. Ability to meet financial obligations is important for every business. So there are now, as a way of knowing, right? If a company has a quick ratio that is greater than one, then that company is in a pole position to meet her financial obligations. But where a company has a financial a quick ratio rather, that is less than 1, it means that the liabilities of the company are greater than the assets, the quick assets of the company. So what it means is that the company might not be able to meet up with her obligations as at when due. And that's a red flag. That's a red flag. So it will mean that the company is over leveraged. They are taking on too much debt vis-a-vis their assets that can return value on those debts. Okay, and so you want to take that very seriously when you are analyzing a company that you want to invest in. Now, there are certain things that represent what you call quick assets. There are certain things that represent what you call quick assets. So the one of them is what you call cash. Everybody knows what money is. Money is cash. Cash is money. So the cash reserves, the funding reserves of any company is one of the quick assets that the company has. So if you're looking at the balance sheet of a company, you want to look at what is the cash reserve of that company. Bank balances, how much does the company have as a balance? All right. So closely related to that is what you call cash equivalents. So the company, you want to know how much cash the company has. It might be shareholders' funds, it might be, things like that. Then the next thing you want to look at is the cash equivalents. How much cash equivalents does the company have? And when we talk about cash equivalents, We're talking about near cash instruments. We're talking about money market instruments like treasury bills that a company can easily sell and recover money in a very short time. Highly liquid assets, right? They are not cash in themselves, but they are near cash because they are instruments or they are vehicles that once they're on the market, for instance, the money market, people are willing to take those things over at the snap of their fingers. So the other quick asset we want to look at will be what you call account receivables. When we talk about account receivables, we're talking about expected cash inflow from customers, from distributors, from wholesalers of the company whose stock you want to buy. And let me give you an example. Let me give you a practical example. Let's say you want to buy shares of a company that manufactures cement or one of these industrial goods. Okay, so you want to check what is the account receivables tenure for such a company's operations. How do I mean? Let's say that company is into cement manufacturing and cement distribution and all of that. You want to check what's the nature of their payment system, credit system with their customers, with their distributors. Do they receive upfront payments before goods are shipped to those customers? Do they give those customers credit facility? Let's say 30-day credit facility, or a 60-day credit facility, or a 90-day credit facility, and what have you. Now, these issues I just raised are very important because if a company receives money quickly, it is better suited and it will have a better quick ratio than a company that gives extended credit facility to her customers. All right, so that is a very important thing to look at. These are the nitty-gritties that savvy investors look at when they look at balance sheets of companies and all of that. So as I tie up this aspect of the fundamental, the quick ratio aspect, I said, like I said before, a company should have a quick ratio that is higher than 1. Remember what the formula is. So a company should have a quick ratio that is higher than 1. If a company has a quick ratio that is higher than 1, then that company is very well positioned. It has enough cash flow. It's using leverage well, and it's in pole position. And it's one of the boxes you should check, in making your investment decision to buy that particular stock. Like I said before in one of our videos, these ratios, these indices or metrics that I'm highlighting, they work together with other metrics. So you don't make a decision based on one metric. So what I mean in effect is a company has a good quick ratio doesn't necessarily mean you need to buy that stock. You need to look at the other metrics, which is why you need to watch this video to the end, because I'm going to talk about another metric shortly. The metric I'm going to talk about next is the profit to earnings ratio. The profit to earnings ratio. Okay, so what's the profit to earnings ratio? It is the ratio of the company's share price over the earnings per share of that stock. The company's share price over the earnings per share of that stock. Now, what do you mean by earnings per share? Earnings per share. We're going to do another video where we do a more detailed description of earnings per share. But for the purposes of explanation of this particular fundamental, earnings per share simply tells you how much the stock is making per unit of the share. How much the stock is making per unit of the share. I'll just leave it at that so that you can get the context. So when you divide the share price by the earnings per share, which I just described, you get the profit to earnings ratio. Now, the profit to earnings ratio is a very important fundamental because it's a measure of profitability. It tells you how profitable a particular company's stock is. It tells you if that company is making money and is, it's giving money to its shareholders. It has the potential to give money to its shareholders and all of that. Now, profit to earning ratio is very important because when you want to buy a stock, you are looking at the profit to earnings ratio, right? For certain reasons, you're comparing it with the historical data of the company. You're comparing the profit to earnings ratio of the company at that point, and you're checking it against the previous performance or the historical performance of the company. Okay, now it will help you to know if that company has a growth potential. It has a growth trajectory. Okay, so one of the reasons you're checking the profit to earning ratio, apart from profitability, and also checking the historical data, is that it helps you to tell how far the company has gone over time. Okay, in its profitability, it's been profitable over the past 5 years, it's been profitable over the past 10 years, and all of that. Then comparing it with where it is now, the profit to earning ratio is good. So that gives you an idea that that company has been doing well over time and has remained profitable over time, because you want to invest in a stock that has a history of profitability. Okay, now the PE ratio, I would now say, now that I've said it repeatedly, there are two ways to it. There's what you call the forward PE ratio, and then there's what's called the trailing PE ratio. Investors there's a dilemma amongst most stock investors as to which of them is better, in making an investment decision, whether the forward PE ratio or the trailing PE ratio. My thoughts are simple, and they are these. I think both are important, and I'll tell you why I feel both are important. Past performance can be indicative of future performance. It's not always indicative, but can be indicative. So you want to look at the trailing PE ratio, all right? You want to look at how well they have done over time. That's what you call the trailing PE ratio over time, okay? And then you also want to look at the forward PE ratio. Now, most investors prefer the forward PE ratio because they feel that it is a projection of how much a company will make. Now, most times, analysts and even insiders within the company set the PE ratio, the forward PE ratio, because it buoys investor confidence, right? This is the forecasted PE ratio and all of that. So most investors tend to look at the forward PE ratio, and they use that as a basis for their investment decision. So, but like I said, I believe both are important. So you look at the trailing, you look at the forward, all right? And like I said before, past performance can be indicative of future performance. So in this video, we have looked at two very important fundamentals: the quick ratio and then the profit to earnings ratio. Okay, so I believe this has been educative and informative. In case you are not yet subscribed to our channel, please hit the subscribe button, like this video, share it with your friends, share it with your loved one, share it with people that you know need to be more financially literate. And I want to encourage you. You can go online and do a little research and put the pieces together of everything we have said in this video. And then if peradventure you have questions for what we have said, please drop your questions in the comment section. We'll be more than delighted to attend to those questions. So until the next video, where we take on more fundamentals, where we take on more issues regarding savviness in stock market investment. Thank you for seeing this video, and have a good time. Bye for now.